China and US trade wars, tariffs, inflation, rate cuts, and how all of this is affecting your crypto. There will be life-changing opportunities from all of this. And I'm not only going to explain why I think this, but I'm also going to be showing you what you should be doing about this. So to set the stage for this entire video, I'm going to start off with a post from the Kobayashi letter, breaking China's President Xi Jinping tells President Trump that he is ready to continue working with Trump to strengthen Chinese and US relations, okay? Now, this is important because you had these whole talks about trade wars. Trump also went down this week to meet with Xi Jinping and to discuss trade wars. And we're gonna get into some of the finer details in terms of these trade wars. And this is extremely important to your crypto bags because this is gonna tie into inflation and how the tariff inflation affects your crypto holdings and where these opportunities are and how you can take advantage of them. Another post, breaking, President Trump announces that the US and China have reached a one-year trade deal on rare earths and critical minerals. In return, the US is cutting tariffs on China, and the one-year agreement will be negotiated every single year. So this is also good because before these two weren't even coming to the table, and understanding that yes, tariffs do get passed on to the consumer in the end of it all, it's a good thing to have tariffs at least have some finality with tariffs, because ultimately this is terrible for markets and terrible for your crypto bags. And the one thing that we all want is new Bitcoin all-time highs, and one thing we really all want is new altcoin all-time highs. So getting this deal out the way and getting a clear-cut set tariff across the board, across all countries, it seems like it's the hardest thing in the world to hope for and ask for right now, but doing that would help ease the market's fears with not only inflation, because the Fed will have an easier job determining whether inflation is coming mostly from tariffs or if it's just regular inflation that they're already dealing with, and this seems to be going in a good direction. Now, to break it down a little bit, okay, President Trump announces China's tariff reductions after amazing meeting with Xi Jinping, including, we're just going to politely skip over that first one because YouTube doesn't like that first one, okay? Secondly, overall tariffs on China reduced from 57% to 47%. China to discuss chip restrictions with NVIDIA, which has been hurting China a lot. Okay, no more obstacles on rare earths. China and US to collaborate on Ukraine to stop the war that's going on there. That's always a good thing. A trade deal appears to be coming next week. Okay, so they had a talk today. We're going to get all the finer details as the days and weeks go along. I think we're heading in the right direction. I really don't want to see tariffs continue. And this last post kind of details out what Trump thinks about it, which is pointing in a good direction. On a scale of 0 to 10, I would say the meeting with Xi Jinping was a 12, which is amazing for people like us, because now the Fed can make more constructive decisions, especially with the government shutdown. Now, I know not a lot of people like to hate on Jerome Powell and the Fed, but at the same time, you have to understand that it is making his job even harder. So if you thought he was incompetent, these things don't help his case and situation any more than it helps ours. So having the government shutdown end and having it reopen, and also having tariffs at a scale, because there's one thing I want to get into this video at Jerome Powell said. We're going to talk about what Jerome Powell said at the CPI meeting yesterday. He was pretty much saying that if tariffs are set in place, then inflation can only go up as high as those tariffs are set, right? So for example, if it tariffs across the board on the rest of the countries around the world, we're at 10%, then theoretically the prices of goods and services will go up 10% to combat the tariff inflation. Now, the consumer would take on a lot of the extra cost when going into the stores to buy the regular goods and services. And then a lot of that money would then flow back into the U.S. economy through various means, as far as taxes and things like that, and fees that have to be paid on these tariffs, I should say. So it's not the best thing for the consumer. The American economy, you can argue, depending on which side of the fence you fall on, that it's a good thing for the American economy. But regardless, we're going to get into all this and explain what I mean by all this. So if you're a little bit lost, I'm just setting the stage for this video. I'm going to tell you the opportunities that align. There's a lot of great opportunities that you can take advantage of. So in my opinion, one of the biggest things happened this week, which was the Fed cuts interest rates and will end QT on December 1st. And we're going to break all of this down and how it affects your crypto bags, and it's going to provide us a juicy opportunity. Previously, the Fed rate was at 4.25%. They actually dropped it to 4%. The Federal Reserve delivered a 25 basis point rate cut to 3.75 to 4%, as I just said, and announced it will end the balance runoff on December 1st, marking a clear step towards financial policy easing. Though job growth slowed and the unemployment rate has ticked up slightly, inflation, meanwhile, has moved higher since earlier in the year and remains somewhat elevated, prompting the Fed to emphasize its ongoing commitment to returning inflation to 2% over the longer run. The Fed revealed that starting in December, it will reinvest all maturing Treasury and agency mortgage-backed securities principal payments into short-term T-bills. And don't get confused. I'm going to explain this. If you understand it, great. If you don't, I'm about to explain it. Effectively halting quantitative tightening and stabilizing the size of its balance sheet. So if you're sitting there scratching your head about what the hell I just said, let me explain it to you. So the Fed holds a lot of government debt in the form of treasury bonds. Now, if you don't understand how treasury bonds work, it's very, very simple. Treasury bonds are ways that institutions, the Federal Reserve in this case, and people like us, myself, can go and loan out money to the government in hopes of a return. Now, when you're doing treasury bonds and you're buying treasury bonds and you're forking over that money to the government, they're promising you a yield over the course of, let's say it's 5 to 10 years, whatever the term is, right? When it comes to T-bills, it's shorter term, so it's 3 to 6 months to a year, and they offer you an interest on that money. So the whole point of why you buy treasury bills is because the government is promising to pay back that money at a certain time, at a certain percentage, right? Now, the government itself can go ahead and use a lot of this money that it's getting to spend in the economy, whether that's to build roads, to build schools, or to invest in AI, right? Or other various industries that may be on the up and coming, right? Long story short, when these treasury bonds mature, meaning the Fed is now owed back this money from the government, they're actually choosing to take the money that they got back from the government and the interest that they got back from the government and take that money and reinvest it to buy more treasury bills. So treasury bills are shorter term, 3 to 6 months to a year. So they're pretty much giving the money that they just earned, right? That the government just paid them back to the government so that the government can use that money to spend within the economy, to inject liquidity into the economy and end quantitative tightening. This is extremely important because the Fed only has a few different ways, a few different tools that it can use to stimulate the economy, to help GDP growth, to help the economy grow, to help the stock market, and of course, like we all know, crypto, right? This is why you're watching this video, to help your crypto assets grow, right? And a lot of that money eventually does trickle into these asset classes. It doesn't all go to the stock market and the crypto markets and things like that, but a lot of that money eventually does trickle down, whether it's through businesses getting this money and then they use it to buy different crypto assets, which is a big one this time around because you're seeing a lot of investment in ETFs for various crypto assets. So I do think that's one way where a lot of this money will trickle into the crypto market. And then as the landscape begins to ease, right, that's the point of quantitative easing, then you're going to start to see a lot of these riskier assets that we all love, like altcoins and micro caps, low caps, mid caps start to do very well because those assets always do the best when the most liquidity is in the system. And the mechanism that the Fed is using is starting to pump money back into the system, which is a green light for all of us. Now, this is actually starting on December 1st. This is what the Fed said, and I'm going to show you a clip of the Federal Reserve and what Jerome Powell said, which was very interesting to me, for those people who think that the bull market is ending and that we're stuck to this 4-year cycle. I've been trying to bash it through your heads for the past, 6 months or whatever the case is now, however long it's been, that this 4-year cycle theory thing was a possibility this time around, but it's funny enough that this time is actually the time that's different. It's crazy we always say this, but this is the actual time where it is different.
Done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So
if you heard what he said we're trying to get to the end of this cycle, meaning it hasn't happened yet. And what cycle is he talking about? The business cycle. This is something I talk about every single video. Now, if you couldn't hear that, I'm actually going to just throw a clip in here so you can watch this video. So hopefully you just seen that and you understand what I'm saying. He's trying to tell us that, listen, we're on the right track to getting to the end of the business cycle, which is the peak phase, right? Until we start to come back down, similar to how we did in 2022. So for those of you that are watching this video and you're scared and worried that the cycle's over, I'm here to tell you again, the cycle is not over and you're missing a massive opportunity, because later in the video, we're going to get into the charts and everyone's on doom and gloom. I don't know why everyone's so doom and gloom, and the markets are actually crashing right now. And for whatever reason, the fear and greed index is striking over to fear now as well. It's crazy, but I'm going to calm you down and I'm going to reel you back in so you can understand how to capitalize, okay? How to capitalize. Now, obviously, before we start, we got to talk about the Fed watch tool. And even though Jerome Powell said that he's not sure if he's going to cut interest rates come December, right, the December 10th meeting, it's still 72% chance that we will on the probability chart. Now, understand that every single time we've used the Fed watch tool from CME Group, we've been able to predict whether or not we're getting a rate cut every single time, right? And the amount that we're going to get. So right now we're at 4%. Don't forget that. So I do think we're going to get another 0.25 basis point rate cut. And the part that nobody's considering or talking about is that he's not getting unemployment data. Not having unemployment data as the Federal Reserve is tough because of the government shutdown. You're not understanding if you need to be lowering interest rates, keeping the same. But the reason why this is important is because if a lot of people are losing jobs, that means a lot of these companies probably don't have the money or the liquidity necessary to continue to hire and keep these people employed. So a quick few posts that I want to highlight as well is from Cryptos R Us, big crypto YouTuber. Crypto just got invited into the Federal Reserve. Now, this actually happened a few weeks ago, right? A week ago, but I want to talk about it today because this is a very important piece of information. I haven't given you one of these market update videos in 2 weeks. So here it is. Fed Governor Christopher Waller opened the Fed's first Payments Innovation Conference with a message nobody expected. This is an era for the Fed, one that's open to DeFi and crypto, which we've never had before. We've always been the number one competitor when it comes to banks, and this is why a lot of the crypto rails and a lot of our crypto assets have been shut down over the years. He said the industry isn't being pushed to the sidelines anymore. It's being brought into the conversation of the future of payments. The Fed is now talking about stablecoins, tokenized assets, and AI-driven payments, and it's not as threats, but as a part of the system. For the first time, it feels like the Fed isn't fighting the disruption, it's leaning to work with it. Massive, I don't need to say anything. That's pretty self-explanatory. There's another one from Cryptos R Us around that same day. Fed opens door to crypto banking. This is something I talked about. I'm going to leave a video at the end of this video. Click on it. It's going to pop up on screen at the end of the video. It's going to talk about this exactly, okay? And the different crypto assets you should be holding. Anyways, Governor Chris Waller announces the central bank is proposing a new limited access or skinny master account that would give legally eligible institutions direct access to the Fed's payment rails without relying on partner banks. I hope you didn't click off this video because that opportunity I promise you is coming in the next slide, and it should be an obvious one, but for whatever reason, it's still not. Anyways, this streamlined model could fast-track access for crypto banks and stablecoin issuers, marking a potential turning point in how digital asset firms interact with U.S. financial systems. Now, we're not going to watch the video I have up on screen, but I want to show you something I thought was really interesting, and this is one of the many opportunities that could come up this year. This is Sergey Nazarov, okay? He is the CEO and founder of Chainlink. Now, you can see his badge right there. Federal Reserve Payments Innovation Conference. This is exactly what Crypto R Us was just posting about and what he was talking about. Bridging TradFi, which is traditional finance, and DeFi with BNY Mellon, one of the largest banks on the planet, banking institutions, and Chainlink and more. Now, Chainlink is literally in the Federal Reserve and is going to be used for federal payments. Now, Chainlink is only sitting, at the last time I checked, a $12 to $13 billion market cap. And you're talking about trillions upon trillions of dollars within the Federal Reserve, right? I think the housing market alone is like 55 trillion. So just gobbling up a percent of that, right? We're not even talking about the stock market and the banking system and everything else, right? Chainlink is the underpinning technology that's going to bridge all of TradFi on chain, right? It's an oracle. The fact that I've talked about Chainlink for the past like year and a half, I got into Chainlink at $7 per token. Now remember what I said, quantitative tightening is going to end December 1st, and you're going to see a lot of altcoins start to move up towards the end of the year and definitely into the first quarter of next year. And you want to be positioned in things that have real market value, that generate real revenue. This is why I talk about Chainlink. This is why I talk about Morpho. This is why I talk about Aerodrome and Coinbase applications. This is why. It's because they're working with the government, they're working with legislation, they're working with future payment structures, and these are the main players on the crypto side, right? That's one of the opportunities, and Morpho's the other one as well, and Aerodrome is the third one. But anyways, you'll find out more about that at the end of this video when you click the next video. Now, just to throw a little bit of sauce on it, okay? Just in, Coinbase CEO Brian Armstrong meets with Senate Democrats today to advance crypto market structure legislation. We just talked about this. Key agenda, clarifying trading rules, boost investor protections, and support responsible Bitcoin and crypto growth. Okay, this is a bunch of jargon, but support responsible Bitcoin and crypto growth pretty much just means pump our bags, and we want to do it safely. That's pretty much what he just said. BTC adoption is evolving fast, as we all know, but this is why I'm so heavy on the Base ecosystem, right? And Coinbase as a whole, because these are the people that are front running everything, right? Brian Armstrong and Sergey Nazarov are mountains ahead of Brad Garlinghouse and XRP. I hate to be the guy who just, continues to just clown on XRP, but XRP has, like, last time I checked, it was like just over $100 million. Sorry, just under $100 million in locked TVL across the entire platform, but it's sitting at over $100 billion in market cap. Like, make it make sense. And if you don't believe me, go on DeFi Llama and check for yourself. Right? Do a quick Google search, check for yourself. They're not making as many of these banking relationships as you think they are. The one that's actually doing it is Chainlink. So you should do your own research and you should look into why. And if you clicked off this video because I'm being truthful, I don't really care, because this is what you need to hear. And I don't want you to get psyoped. Do not get psyoped into the madness. Look at where the money's going, right? That's the most important thing. Where is the money? And it's not on XRP Ledger right now. It's going to Chainlink and Base. I'm telling you. And ETH, obviously, but I'm telling you this right now. To get back onto the unemployment stuff, right? Because this is important. I want to give you some facts and proof of what I'm talking about. Mind you, the government shutdown is here. They can't see the unemployment data, but news is coming out from across of a lot of massive companies about layoffs. Amazon targets as many as 30,000 corporate jobs cut, sources say. Now, this is this is the biggest company in America, right? Other than NVIDIA, obviously, but one of the biggest companies. Amazon is planning to cut as many as 30,000 corporate jobs beginning on Tuesday as the company pairs expenses and compensation for overhiring during the peak demand of the pandemic, according to 3 people familiar with the matter. The figure presents a small percentage of Amazon's 1.55 total million employees, which is massive, but 10% of its roughly $350,000 corporate employees. So this may be a little bit skewed because it's not that much of the overall amount, but it's a lot of the people that probably make the most in Amazon. I'm pretty sure they're finding different uses for AI to take away a lot of these people's jobs, and understanding that they don't have enough money being pumped into the economy right now to keep these people aboard and afloat. And I'm almost certain that a lot of this trend is going to continue, and you're going to see a lot of other big companies making similar movements, especially when we've had such good earning calls this time around. It's going to be hard to beat a lot of these earning calls next quarter, right? When they have earning calls at the beginning of next year for Q4 of this year. So you're going to see a lot of these companies finding different ways to shave the books and shave all this extra spending on their balance sheet. So I expect a lot more of these layoffs to continue. And this is going to prompt the Fed to have to lower interest rates and eject more money into the economy. Now, I want to show you an interesting correlation, and this is my thesis for what's going to happen in the coming months and how you should be positioning yourself. There's a correlation between the unemployment rate and the interest rates, like I talked about already. If you go back to 2020 and unemployment was at its highest. Now, I understand why it was at its highest, but that's not the point that I'm making here. If you go back to April 2020, you can see that it was at 15% unemployment. right? And what did the Fed do around this time, right? Even before it happened, they actually dropped interest rates to around 0.25%, virtually to zero. So that lever between unemployment, right, and the interest rates is kind of like an opposite correlation. So if you believe that within the next couple months to half a year or so that unemployment is going to rise, what do you think the Fed's going to have to do to combat it? They're going to have to lower interest rates. It's as simple as that. The only thing throwing off the Fed right now is the fact that they have to deal with tariff inflation, and they don't know how that is going to affect the markets, and they didn't have a good idea of how it's going to affect the markets, which is why they were kind of slow to cutting interest rates. But because they were so slow to cutting interest rates, unemployment is probably going to start to creep up a lot faster than we thought it was. And when we get to the next unemployment reading, you're going to see this line spark. Sorry, you're going to see this line spike, I should say, just like it did over the past 3 years, right? Unemployment from the bottom of the market crypto market, I should say, has only risen since that point and will continue to rise until the Fed decides to drop interest rates, which we can actually see over here. If we go to the 3-hour chart, the 3-year chart, sorry, and you can see that interest rates started to creep up, right, as unemployment did. And when unemployment creeps up, you gotta lower interest rates, right? It's just an inverse correlation. That's all it is. Very, very simple stuff, but very, very useful stuff. Now, one of the few last things that I want to bring up before I let you go here that's extremely important is you want to know when to buy all these assets, and you want to know if the market is ending, right? There's two most important things. Intracycle, you want to know when we have good buying opportunities. This is why I have up the 50-day, 100-day, and 200-day daily moving averages. Now, the white line here is the 50-day moving average. Now, you notice something that's very, very interesting. We've actually respected the 50-day moving average throughout this entire cycle, and when we crossed over it is when we had a bull cycle commence, and we had this massive run up. So point number one, right, that I'm trying to make is that we shouldn't really be worried that we're going into a bear market and that the cycle's over until we get below this line right up here, which is currently sitting at $102.8 thousand, which we're actually pretty close. But mind you, we've also been close in other points throughout this specific cycle, and we've gotten pretty close, but we've always held it up as support, right? Now, just to give you some understanding, some context, we actually held it as support as well the last cycle, as you can see here, right? And when we headed into a bear market, you can see we crossed over. We had a clear crossover, retest, and then we dipped into a prolonged bear market, right? So I wouldn't be worried until we get below this 102.8 level up here. So we still have a little bit of ways to go. Now, understand something, that when we get into a full-blown bear market, you want to know what the best time to buy is, right? The best time to buy is when we test the 50-day moving average, right? That's the best time to buy, whether it's altcoins, Bitcoin, whatever the case is, right? But the ultimate best time is to buy down here, right? This red line is actually the 200-day, and when we cross below it is usually when we're at the depths of the market, as you can see down here. And that's usually the best time to buy if you just want to buy and hold throughout the entirety of the business cycle. This is one of the best charts and indicators that you can use to keep a cool head when the fear or the greed is too high, because as you can see here, we also get very extended from this line. And when we get super extended, it's also a time to be cautious. And we have other indicators that obviously we use to track these things. One of them that I showed you in the last video was the Nupal. That's a good one to see if we're too overheated, or if you just check the fear and greed index. Whenever you get above 85 to 90 levels, it's pretty much a good time to sell or just take some profits. But the reason why I want to show you this chart today is because I want you to have a clear understanding of when you should be picking up these assets. And I'm not going to lie to you, it looks like the time is coming pretty soon. If we get around to the 104, 103 level, I would just buy. I would just buy whatever assets you've been waiting to buy. And as we've seen from Jerome Powell and different correlations with other charts, we know that the cycle hasn't ended yet, right? We know that. Jerome Powell, the Federal Reserve, said it himself. And he's reinvesting into those treasuries, right? So that means he's giving, he's loaning out his money to the government so that the government can go and spend more money. The government doesn't spend more money at the end of a cycle, right? They start contracting. They stop spending money when they're at the bottom of the market, right? When we go into a bear market. So just keep those things in mind. And just to send you off, right, with a little more hopium if you're still not convinced, JP Morgan CEO Jamie Dimon says crypto and stablecoins will be used by all major banks to facilitate better transactions. This guy, remember what he said. I love that the person down here, Yusuf, amazing. I didn't even have to explain it. He said, oh, how the tables have turned. Jamie Dimon tells Davos that Bitcoin is a pet rock, that it does nothing except help with fraud and money laundering. But his company, JP Morgan, was buying Bitcoin back in 2017, which is what a lot of people don't understand or don't know. And the reason why he says things like this, or has said things like this, is because he wants to get all of his bags in place before Bitcoin truly takes off and has a true ascension. So this has been nothing but an institutional driven cycle. Retail isn't here. But if you're like me, I'm obviously retail, and you're a part of this journey, hit the subscribe button and the like button. Leave your comments below about what you think about where we're at right now. If you think the cycle's over, what you're doing right now, what you're thinking about buying. All this information is important. I love you guys. The cycle's not over. Don't be scared. And I'll see you in the next one.